How to get started with investing. Investing is one of the best ways to build wealth over time and help you reach your financial goals. No matter how old you are, right now is a perfect time to begin investing and increasing your wealth. With enough discipline and planning, you can put yourself on track to build your wealth for your and your family's future. I'm going to tell you everything you need to know about getting started with investing. So why should I start investing? Investing is one of the best things you can do for your financial future. If you start investing early enough, the power of compounding will work to your advantage. Let's look at an example. Let's say you are currently 32 and planning to retire when you are 65, so you have 33 years of working life left. If you put $500 a month in an investment account, that could grow to over $1.1 million by the time you retire, all because of compounding interest, based on a 9% annual return, which is the average stock market return over its entire history. Imagine starting even earlier and the compound interest working on that. How do I start investing? Let's look at how to prepare yourself for investing first. First, pay off your high-interest debts. If you have high-interest debt such as credit card debt, it's best to pay this off first before you start investing. A student loan debt is also something that you should tackle first if you have one. These debts come with high interest rates and will only get bigger over time. Even if you can't repay your debts, make sure not to get any further into debt and focus on paying it off and managing it as soon as possible. If you are looking for actionable financial tips, there's a link in the description below for my free weekly mailing list, which will help you. Second, you need to create an emergency fund. Before you start investing, it's important to have an emergency fund in place that can cover your expenses for at least 3 months. This will ensure that you are prepared if you ever find yourself without a job or need money to cover unexpected expenses. You won't have to use your investment funds if you have an emergency fund if an unexpected expense shows up, which makes it easier to focus on investing for the long term, which is key. Thirdly, think about diversifying your investment portfolio. One of the basic rules of investing is diversifying your investments and spreading them across different asset classes. This will help to reduce the risk of the investments so that if one type of investment performs poorly, other parts of your portfolio can make up for it. Invest in small amounts in multiple asset classes such as stocks, exchange-traded funds, ETFs, mutual funds, real estate, and bonds. Next, think about automating your investing. Once you've thought about your portfolio, you should think about automating your investments by setting up a regular contribution to retirement accounts such as a 401k or IRA. This will ensure that you continually invest and take advantage of compounding interest. You can also set up automatic transfers from your checking account to your investment accounts so that you don't have to remember to do it every month. This way, you can focus on other things while your investments are taken care of. Next, think about setting realistic investment goals. Most people ignore setting realistic goals and make risky investments that they later regret. Setting goals is not just investment advice, it's good life advice. Set realistic investment goals that are achievable and then start making plans to reach them. For example, if you want to save enough to get your first car or house, set a specific timeline and start investing in small increments to reach your goal. Investing for retirement should also be part of your long-term plan so that you can live comfortably after you retire. Next, think about the risks involved with investing and what you can stomach. With any investment, there is always a certain amount of risk involved. So before you start investing, make sure that you understand the risks associated with the asset class in which you are investing. For example, stocks can provide great returns, but they also come with increased volatility and loss potential. Similarly, real estate investments require more capital than other types of investments and come with their own set of risks. Make sure you understand the risks involved before investing so that you can make informed decisions and manage your investments accordingly. Again, diversification is the key to managing risk and should be part of your overall investing strategy. Next, think about creating your investment strategy. Every individual is different. Therefore, it is essential to create an investment strategy that works for you and reflects your financial situation and goals. Your investment strategy should include the types of investments that you want to make, how much risk you're willing to take on, how long you plan to stay invested, and any other considerations important to you. A plan will help you stay on track and reach your investment goals. Next, think about monitoring your investments regularly. It's essential to monitor and review your investments regularly. As markets and regulations change, you may need to make adjustments to your portfolio to align with your goals and objectives. Checking the performance of your investments regularly will help you find any discrepancies and opportunities for improvement. This will ensure that your investments are working as hard as possible for you and that you're getting the most out of them. Make sure you take advantage of tax deductions. Many investment vehicles, such as 401ks and IRAs, allow you to take advantage of tax deductions. Taking advantage of these tax deductions can help reduce your taxable income, which means more money in your pocket. You should also look for other opportunities to save on taxes, such as capital gains exemptions, Roth IRA conversions, or charitable contributions. Investing in a careful and tax-efficient manner can help you save more money in the long run. You can also get professional help from a personal capital advisors corporation or other qualified financial advisors to ensure that you are taking full advantage of all tax benefits available to you. Next, make sure you get a life insurance policy. Investing in a life insurance policy is another smart way to protect your financial future. A good life insurance policy will protect your family and give them the peace of mind they need during difficult times. In addition, some life insurance policies also have medical benefits, disability benefits, or other features that can help you cover medical expenses or provide extra income in an emergency. This way, you won't have to use your savings or retirement investments to cover unexpected costs and can use your investments for their intended purpose. So what kind of investments are the best to get started with? Now let's look at some of the best investments you can start with. 1. Retirement savings. Opening an individual retirement account would be a good idea no matter your age. IRAs and 401ks are great investments as they offer tax-free investment growth and are designed to be long-term investments. If you work at a firm, your employer might offer a 401k plan that you can take advantage of. 2. Stocks. Stocks are among the most rewarding investments out there, but they come with a certain level of risk. If you want to invest in stocks, it's best to diversify and buy a range of stock types from different industries to reduce your risk. If you invest wisely, stocks can give you a return of up to 10 to 15% in a year. 3. Mutual funds. Mutual funds are investment vehicles that pool the money of thousands of investors to buy stocks, bonds, and other types of securities. These investments come with an element of diversification built in as they contain many different assets, which can reduce risk and provide consistent returns over time. Like stocks, mutual funds can also give you an annual return of 10 to 15%. 4. Real estate. Real estate is ideal for your retirement investment because it's both inflation-proof and has high returns. Investing in real estate can be incredibly lucrative, but it does come with a hefty price tag. This is because properties are usually expensive, as well as the associated fees and taxes that come with them. If you can afford to invest in real estate, then it's an excellent option for long-term investment growth. 5. Bonds. Bonds are known as one of the safest and most reliable investments out there. You make loans to governments, companies, or other entities in exchange for a fixed interest rate. This means that you get regular payments over time as the bonds mature. What are my top tips to getting started with investing? Let's take a look at a few of my top tips to increase your chances of success when investing. First, invest regularly. Investing is not a one-time thing. To be successful, you have to invest regularly. This means setting up an automatic investment plan and depositing a set amount of money into your investments each month or quarter. Even if it's a few $100s a month, the amount will add up over time. Second, start with low-risk investments. As a beginner investor, starting with low-risk investments like mutual funds or index funds is important. These investments are less likely to experience large swings in value and can provide more stability for your portfolio. Once you understand how things work, you can move to more complicated, higher-risk investments. Third, get help from financial advisors. A financial advisor can help you create a personalized investment plan and advise on the best investments for your goals. They will look into your financial situation and make recommendations based on your specific needs. This way, you can rest assured that your investments are helping you reach your financial goal. Fourth, know when to cut your losses. No one likes to lose money when investing, but it is inevitable. The key is to know when to cut your losses and move on. If a particular investment isn't performing as expected or no longer fits your overall investment strategy, don't hesitate to sell it and reinvest in something else. Fifth, invest for the long term. Investing is more like a marathon and less like a sprint. This means that you should be looking at investments with a long-term mindset. Don't get too hung up on short-term gains or losses, and focus instead on the big picture of your overall portfolio. 6. Educate yourself. Investing is a never-ending process, and staying current on the latest developments is important. Read financial news, subscribe to this YouTube channel and my mailing list, link below, and talk to other experienced investors. This way, you can stay ahead of the curve and make smarter investment decisions. Have a look at this playlist next to keep on building your financial knowledge. Be sure to subscribe, like this video, and get more free tips by signing up for the weekly newsletter below. I'll see you in the next video. Thanks for watching.